Imagine this. Your husband of 42 years passes away. You're barely sleeping. You're barely eating. The house feels empty. Every room reminds you of him. And then 11 months later, you sit down with a tax advisor and they look at you across the desk and they say, "I'm sorry. You missed the deadline. There's nothing we can do now. You had 9 months. The IRS gave you exactly 9 months after your spouse's death to file one critical form. And because nobody told you, because you were grieving, because you thought your estate was too small to worry about, you may have just lost a tax shield worth up to $15 million. This is not a scare tactic. This is federal tax law. And today, I am going to make sure this never happens to you. I am Timothy, and I help retirees and seniors understand the government rules that affect their money, their benefits, and their families. Today's video could be one of the most important videos you ever watch, because I'm going to explain a rule that the IRS expects every surviving spouse to know, but almost nobody does. I'm going to tell you exactly what the rule says. I'm going to tell you the exact form you need to file. I'm going to tell you the deadline, the extension, and even a backup option if you've already missed it. But I need you to stay with me all the way to the end, because at the 8-minute mark, I'm going to reveal a hidden second deadline, a completely separate 9-month rule that most estate attorneys don't even mention in initial consultations. And near the very end, I'll give you 3 simple steps to protect yourself starting today. So, if you are a surviving spouse, or if you love someone who might be one day, please don't click away. This information is too important. Let's begin with a story. Robert was 67 years old. He and his wife Linda had been married for 38 years. They lived in the same home they bought together back in 1992. They had a small pension, some savings, a life insurance policy, nothing extravagant. When Linda passed away in the spring of 2025, Robert was devastated. His children helped him with the funeral. His neighbor brought meals. His pastor checked in every week, but nobody, not his children, not his bank, not his insurance agent, told Robert about IRS Form 706. Robert assumed that form was only for the wealthy, millionaires, billionaires, people with yachts and trust funds. His wife's estate was worth about $900,000, well below the federal filing threshold, so he did nothing. 14 months went by. Robert's financial advisor called him in for a routine review. That's when the advisor asked the question, "Robert, did you file Form 706 to elect portability?" Robert stared at him. He had never heard that word before. Portability. The advisor explained, by filing that single form, Robert could have inherited Linda's unused estate tax exemption, $15 million of additional protection. Combined with his own, their family could have shielded up to $30 million from the federal estate tax. "But I'm not rich," Robert said. "Why would I need that?" Here's why. Robert's home had appreciated significantly. He had life insurance proceeds. He had inherited Linda's retirement accounts. And if Robert were to remarry, or if the tax laws change again down the road, that protection could have saved his family hundreds of thousands of dollars. But he missed the 9-month deadline, and the automatic extension period had passed too. Now let me be clear. Robert's story is fictional, but the rule that caught him is absolutely real. And versions of this story happen to families across this country every single month. So let me break down this rule in plain English, step by step. Doer Part 1, the portability election. Here's the core rule. When a married person dies, the IRS allows the surviving spouse to inherit whatever portion of the deceased spouse's federal estate tax exemption was not used. The IRS calls this the deceased spousal unused exclusion amount. You'll hear tax professionals call it the DSUE or DSUE. As of 2026, the federal estate tax exemption is $15 million per person. That's the threshold set by the One Big Beautiful Bill Act, which was signed into law on July 4th, 2025. With portability, a married couple can combine both exemptions. That means up to $30 million can be passed on free of federal estate tax. But here's the catch. This does not happen automatically. To claim that unused exemption, someone, usually the executive of the estate, must file IRS Form 706. And they must do it within 9 months of the date of death. Not 9 months from when probate starts, not 9 months from when the will is read, not 9 months from when you feel ready, 9 months from the exact date your spouse passed away. And here's what trips up so many families. Even if the estate is small, even if it's worth $100,000, you still need to file Form 706 if you want to lock in that portability election. Let me read you exactly what the IRS says on their own website. An estate tax return also must be filed if the estate elects to transfer any DSUE amount to a surviving spouse, regardless of the size of the gross estate or amount of adjusted taxable gifts, regardless of the size. The IRS put that right there in black and white. Part 2. The extension and the safety net. Now, what if you're watching this and thinking, I already missed that 9 months? Don't panic. There are two safety nets. Let me explain both. Safety net number 1. If you are still within the original 9-month window, you can file IRS Form 4768. This is an application for an automatic 6-month extension. It pushes your deadline to 15 months after the date of death. You must file Form 4768 before the original 9-month deadline expires. And I want to be very clear, this extension gives you more time to file, but if any estate tax is owed, you still must pay it by the original 9-month deadline. The extension is for the paperwork, not the payment. Safety net number 2. If you missed both the 9-month deadline and the 15-month extended deadline, there may still be hope. Under Revenue Procedure 2022-32 from the IRS, estates that were not otherwise required to file, meaning the estate was below the filing threshold, can still elect portability by filing a complete Form 706 on or before the 5th anniversary of the spouse's death. You must write this exact notation at the top of the return, filed pursuant to Revenue Proc 2022-32 to elect portability under Section 2010 CE5A. There is no user fee for this. No need for a private letter ruling, but it only applies to estates that were below the filing threshold. If the estate was above the threshold and you missed the deadline, you would need to pursue what's called a Section 9100 relief request. That involves applying for a private letter ruling from the IRS, which costs thousands of dollars in fees and is not guaranteed to be approved. Part 3, the second 9-month rule nobody talks about. Now, here's the part I promised you, the hidden second rule. There is a completely separate 9-month deadline under a different section of the tax code. It's called the Qualified Disclaimer, and it falls under Internal Revenue Code, Section 2518. A qualified disclaimer allows a surviving spouse or any beneficiary to legally refuse an inheritance. Why would someone do that? Usually for estate planning purposes. Perhaps the inheritance would push them into a higher tax bracket. Perhaps they want the assets to pass directly to their children or into a trust. But the IRS says you must make that disclaimer in writing within 9 months of the date of death. And unlike the portability election, this deadline cannot be extended. There is no 5-year backup. There is no simplified method. If you miss it, it's gone. And there's another condition. You must not have already accepted any benefit from the property. If you deposited a check, moved into the house, used the bank account, the IRS considers that acceptance. Your right to disclaim disappears. Part 4, the home sale trap. And while we're talking about deadlines, let me tell you about one more that catches surviving spouses completely off guard. Under IRS Publication 523, a surviving spouse can exclude up to $500,000 in capital gains when selling the family home. That's the same exclusion married couples get when they file jointly. But you only keep that higher exclusion if you sell the home within 2 years of your spouse's death. And you must not have remarried before the sale. After 2 years, your exclusion drops to $250,000. On a home that has appreciated significantly over decades, the difference between those two numbers could mean tens of thousands of dollars in capital gains tax, or even more when you factor in the 3.8% net investment income tax, and any state taxes. Part 5. Social Security Survivor Benefits. One final point. When a spouse dies, the surviving spouse may be eligible for Social Security survivor benefits starting at age 60 or age 50 if you have a qualifying disability. You must have been married for at least 9 months before your spouse's death, and if you remarry before age 60, you generally lose eligibility. There is also a one-time lump sum death benefit of $255. It's a small amount, but it must be claimed within 2 years or you lose it entirely. Social Security also limits retroactive payments to 6 months. So if you delay applying for survivor benefits, you could lose months of income that you'll never get back. All right, I know that was a lot of information, so let me simplify everything into 3 steps you can take right now to protect yourself and your family. Step 1. Talk to an estate attorney or a CPA now before anything happens. Do not wait until a spouse passes away. Sit down with a qualified estate attorney or a certified public accountant and ask them specifically about the portability election, Form 706, and your estate plan. Ask them, if one of us dies, what needs to be filed within 9 months? Get that answer in writing. Put it in a folder. Tell your children where that folder is. If your spouse has already passed and you're within the 9-month window, contact an estate professional this week. Not this month. This week. Time is the one thing you cannot get back. Step 2. Report the death to Social Security immediately and apply for survivor benefits. Call the Social Security Administration at 1-877-721213. You cannot apply for survivor benefits online. It must be done by phone or in person at your local Social Security office. Ask about your eligibility for monthly survivor payments and the $255 lump sum death benefit. Do not delay this. Every month you wait could be a month of benefits you never receive. Step 3. Know your deadlines and write them down. I want you to write these down on a piece of paper and tape it somewhere you will see it every day. 9 months after the date of death, file IRS Form 706 for the portability election, and execute any qualified disclaimer if needed. 15 months, the extended deadline if you filed Form 4768 for an automatic 6-month extension. 2 years. Sell the family home if you want the $500,000 capital gains exclusion. Also, the deadline to claim the $255 Social Security death benefit. 5 years, the last chance for a late portability election under Revenue Procedure 2022-32, but only if the estate was below the filing threshold. These are not suggestions. These are hard deadlines set by the IRS and the Social Security Administration. Missing them can cost your family real money. Money that could pay for your care, your grandchildren's education, or your peace of mind in retirement. Now, before I let you go, I need to say something important. The rules I just shared with you today are current as of 2026, but government policies change, tax thresholds get adjusted, new laws get passed, and the IRS does not send you a personal reminder when a deadline is approaching. That means you cannot rely on just this one video. You cannot rely on YouTube notifications. You cannot assume someone will tap you on the shoulder and say, "Hey, you have 3 months left." That is why I built something specifically for you. Right now, in the description below this video, there is a link to join the Global Senior Alerts official WhatsApp channel. When you join, you will be able to download a free senior benefits protection guide that covers Social Security, pensions, estate tax deadlines, banking rules, insurance policies, and travel regulations for seniors. You'll also receive real-time alerts whenever there's a change to a rule that affects your retirement, your benefits, or your family's financial security. No spam, no sales, just clear, accurate information sent directly to your phone. Because I believe every senior in this country deserves to know the rules before the rules are used against them. If this video helped you, please hit the like button. That one small action helps this video reach another widow, another widower hour, another family that might be running out of time right now without even knowing it. Share this video with your spouse. Share it with your children. Share it with your neighbor, because the person who needs this information the most might not be searching for it. They might be sitting at their kitchen table right now dealing with grief and assuming that everything is fine.